At its peak, Nortel Networks was worth $366 billion, a third of Canada's entire stock exchange. 95,000 employees, a century of engineering brilliance. Then executives allegedly manipulated billions in earnings, collected millions in bonuses, and when the empire finally collapsed, 60,000 pensioners were left with nothing. The accused walked free. To understand how unchecked greed brought down the most powerful tech company Canada ever built, you have to start at the beginning. In 1895, a small workshop in Montreal began wiring Canada's telephone lines. Northern Electric and Manufacturing Company, founded that year, was no more than a supplier of switchboards and cables for Bell Telephone. Yet the men and women who worked there, engineers, machinists, and tinkerers, shared a belief that technology could connect a vast, scattered country. By the 1920s, their company had become the backbone of Canada's phone system, building hardware that carried voices from Vancouver to Halifax. During World War II, the factory floor shifted from civilian telephones to military radios and radar, forging a technical culture that prized reliability under pressure. This focus on engineering precision would remain at the core of the company's identity, even as it rebranded to Northern Electric and later Northern Telecom. When the war ended, the company returned to civilian work with a new sense of purpose. Public listing on the Toronto Stock Exchange in 1917 brought in capital, but it was the post-war boom that fueled rapid expansion. By 1964, annual sales reached $560 million, and Northern Electric supplied nearly a third of all switching equipment in Canada. The next leap came not from the boardroom, but from the lab. In the late 1970s, a team of engineers in Ontario developed the DMS-10, the world's first fully digital telephone switch for rural networks. Launched in 1978, the DMS-10 replaced clattering relays with silicon logic, allowing calls to be routed faster, more securely, and with higher fidelity. The breakthrough didn't just modernize Canadian telecom, it set a global standard. By 1985, the DMS-100 switch was rolling out in the United States, and digital systems accounted for a growing share of the company's revenue. Inside Northern Telecom's research centers, the culture was obsessive. Teams worked long nights to perfect error correction codes, test new fiber optic links, and push the limits of what digital signals could carry. The company's engineers became known for treating every design flaw as a personal affront. Their pride was not in stock prices, but in uptime and call quality. This technical DNA, rooted in the discipline of wartime production and the ambition of post-war growth, gave Northern Telecom a reputation for dependability. It also built trust with Bell and other global carriers, who came to see the company as a partner rather than just a vendor. By the mid-1980s, Northern Telecom was more than a Canadian supplier. Its digital switches powered networks in Europe, Asia, and the Americas. The company's global credibility rested on decades of engineering discipline and the willingness to invest in long-term innovation, even when quarterly returns were uncertain. In 1985, the DMS-100's commercial launch signaled that the age of analog was ending. Northern Telecom, soon to be Nortel, had become a digital pioneer. The stage was set for a run at world dominance, but also for the temptations that would follow when technology met the fever of financial markets. At the height of the dot-com boom, Nortel Networks soared to a level that few companies in history have reached. On July 26, 2000, Its shares closed at 124.50 Canadian dollars on the Toronto Stock Exchange, making it not only the most valuable company in Canada, but one of the largest in the world. The company's market capitalization reached an astonishing $366 billion, a figure that placed Nortel ahead of European telecom giants and just behind the most powerful American tech firms. For a brief moment, Nortel accounted for about 35% of the entire S&P TSX Composite Index. Canadian pension funds, mutual funds, and ordinary investors rode the wave, convinced that this was the future of technology and national prosperity. Inside Nortel's sprawling global operations, more than 95,000 employees powered the machine. Engineers, programmers, and sales teams filled offices from Ottawa to Shanghai, from Silicon Valley to Paris. The company's reach extended across continents, with its digital switches and optical networks carrying the world's phone calls, internet traffic, and data. Nortel's name became synonymous with Canadian innovation, and its executives were celebrated as architects of a new digital era. Analysts and media outlets described Nortel as the engine of the new economy. With each acquisition, Bay Networks in 1998, Iconos in 1999, Cordis in 2000, the company promised to dominate every corner of the communications landscape. The narrative was one of relentless expansion and technical supremacy. The Bay Networks deal alone cost $9.1 billion, and it was paid for with a mix of cash, stock, and fresh debt. These moves were cheered by investors, who saw every bold purchase as proof that Nortel could outpace rivals like Cisco and Lucent. The euphoria was contagious. Politicians touted Nortel as proof that Canada could compete at the highest levels of global business. University graduates dreamed of landing jobs at the company, where stock options promised instant wealth. In the press, stories of overnight millionaires and record-breaking profits fed the sense that Nortel was untouchable. But behind the headlines, the numbers told a more complicated story. The record share price and market cap masked a growing reliance on debt to fund acquisitions and a mounting pressure to deliver ever higher earnings. The company's leadership, flush with Wall Street approval, pushed for more deals, bigger bets, and faster growth. In boardrooms and investor calls, the focus shifted from engineering excellence to financial performance. For a fleeting period, Nortel stood as a symbol of what Canadian ambition could achieve. The scale was breathtaking: 124.50 Canadian dollars per share, a $366 billion market value, 95,000 employees, and a weight on the TSX that no other company had ever held. The mood was electric, the optimism boundless. Yet the very forces that drove Nortel to these heights, acquisition, leverage, and the hunger for market dominance, were already setting the stage for a collapse that would stun the country and devastate its workforce. The pursuit of dominance turned into a buying spree that rewrote the rules of Canadian business. In 1998, Nortel stunned the markets with its $9.1 billion acquisition of Bay Networks, a California-based networking company. The deal was pitched as a marriage of strengths: Nortel's carrier-grade engineering with Bay's enterprise data expertise. Behind the press releases, the financing was anything but simple. Nortel paid with a mix of cash, newly issued stock, and a mountain of fresh debt. Bay shareholders walked away with roughly 21% of the combined company. But Nortel's board approved $4 billion in senior notes, $2 billion drawn from revolving credit, and another $3 billion raised through equity. The interest alone on these new borrowings ran to 7.5%, locking the company into a decade of high-stakes payments. The ink on the Bay deal was barely dry when Nortel moved again. In 1999, it snapped up Ikanos Communications for $2 billion, betting that optical packet technology would keep it ahead of Cisco and Lucent. This time, the company reached for high-yield junk bonds, promising 9.2% returns to investors and tying the debt to projected future cash from the new business. The covenants were strict. Any further borrowing needed board approval, and the pressure to deliver on lofty growth targets intensified. By 2000, the appetite for expansion was insatiable. Nortel spent $1.3 billion to acquire Cordis, a wireless infrastructure firm poised to ride the coming wave of 3G and 4G networks. The financing was a patchwork: cash, convertible preferred stock, and a $500 million bridge loan that would soon be rolled into yet another round of restructuring. The deals kept coming, each one justified as the next leap into the future, each one adding new layers of financial risk. The numbers on the balance sheet told a different story than the headlines. By the end of 1999, Nortel's consolidated debt had ballooned to $7.5 billion. Senior executives and the finance committee assured investors that surging revenues would more than cover the obligations. But the terms were growing harsher. The Ikanos junk bonds carried steep coupons, and the Cordis bridge loan tied up cash that might have gone to research or product development. Internal documents later revealed that these complex debt structures, combined with a growing dependence on cash from subsidiaries, left the company exposed to even minor shocks in the market. Inside the boardroom, the mood was confident, almost defiant. The finance team believed that scale was the only defense against global competition. Every acquisition was framed as a strategic necessity, every new loan as a bridge to greater profits. But the pace of deals outstripped the company's ability to integrate new businesses, and the mounting debt became a silent threat. As the dot-com bubble inflated, Nortel's leaders staked the company's future on the gamble that growth would always outrun risk. The bet would soon come due. In the final months of 2000, the optimism that once surrounded Nortel gave way to panic. Orders for new equipment, which had fueled the company's rise, fell by 30% almost overnight. Global carriers, once eager to upgrade their networks, slammed the brakes as the dot-com bubble burst. The collapse was swift and brutal. In regulatory filings, Nortel disclosed a $3 billion write-down, most of it tied to the Bay Networks acquisition, which now sat on the books as an overvalued asset. The goodwill that had justified the deal was gone, replaced by a cold calculation of market realities. The numbers forced a reckoning. Nortel's debt, already swollen by years of aggressive borrowing, became a crushing burden as revenue evaporated. Interest payments outpaced operating income. The company's debt service coverage ratio, a measure of its ability to pay loans from profits, slid below 1. Senior executives scrambled to preserve cash, but the math no longer worked. In January 2001, the company announced the first wave of layoffs, 12,000 jobs cut in a single morning, each one a family's future upended by the collapse of a corporate dream. Frank Dunn, the chief financial officer, was promoted to CEO in November 2001. The board presented him as a steady hand, someone who could restore order after the chaos. But behind closed doors, the pressure was suffocating. Wall Street demanded stability. Investors wanted reassurance that the worst was over. Dunn, along with Douglas Beatty and Michael Gologly in the finance office, faced a stark choice: deliver results or risk total collapse. Inside Nortel's headquarters, the mood shifted from pride to fear. Teams that once celebrated innovation now braced for the next round of cuts. The layoffs rippled through every division, from engineering labs in Ottawa to sales offices in Europe. The company's global headcount, which had peaked at 95,000, began to shrink with each passing quarter. Every reduction was justified as necessary, but the sense of betrayal ran deep among employees who had believed in Nortel's promise. As the crisis deepened, the temptation to bend the rules grew. The company's financial statements became a battleground, with every reserve, write-down, and revenue line scrutinized for ways to soften the blow. The external shock of the market crash had exposed Nortel's vulnerabilities, but the response would soon cross a line, from desperate measures to outright manipulation. The stage was set for a new kind of crisis, one that would not only destroy careers, but stain the company's legacy forever. Frank Dunn, Douglas Beatty, and Michael Gologly sat at the heart of Nortel's finance operation as the pressure to deliver results reached a breaking point. In the wake of plunging orders and mounting layoffs, the company's financial statements became a tool for survival and for personal gain. Early in each fiscal year, the accounting team quietly built up large reserve accounts, booking $150 million or more for anticipated costs like warranties, restructuring, and inventory write-downs. These reserves, far higher than historical experience justified, gave management a hidden cushion. When quarterly earnings fell short of the numbers expected by analysts, a portion of those reserves was released back onto the books as income. The effect was immediate. Profits appeared to recover, and Wall Street's confidence was momentarily restored. The mechanics were subtle: a debit to the reserve liability, a credit to other income, on paper, entirely permissible under Canadian accounting rules if based on genuine changes in estimates. But the timing and scale of the releases, always coinciding with critical earnings targets, revealed a pattern. Bonuses were tied directly to these targets. Between 1999 and 2002, Dunn, Beatty, and Gologly collected $12.8 million in cash awards, even as Nortel's share price collapsed and its workforce shrank by tens of thousands. Internal memos later surfaced showing explicit instructions to find earnings by manipulating reserves. The finance office also accelerated revenue recognition, booking sales up front and pushing inventory to distributors at the end of each quarter. These tactics, known as channel stuffing, temporarily inflated revenue but created a ticking time bomb for future periods. Expenses that should have been recognized immediately, such as R&D and warranty costs, were deferred, capitalized, or hidden in reserves, further distorting the true picture of Nortel's health. By 2004, external eyes began to probe deeper. The U.S. Securities and Exchange Commission and the Royal Canadian Mounted Police launched parallel investigations, demanding records and interviewing staff. Forensic accountants traced the trails of reserve creation and release, uncovering a deliberate scheme to mask losses and inflate executive compensation. The numbers on the balance sheet no longer matched reality. Nortel's credibility with investors, regulators, and its own employees was shattered. The manipulation of reserves, the engineering of the numbers, became the fatal flaw that would push the company toward public disgrace and ultimately ruin. In March 2005, Nortel wiped $3.4 billion from its books, restating 4 years of financial results and exposing a company built on illusions. Profits that once dazzled investors were revealed as accounting tricks, not the fruits of genuine innovation. The restatement shattered confidence. Nortel's stock, already in decline, collapsed further. By January 2009, Nortel filed for bankruptcy protection in both Canada and the United States, listing $13.5 billion in liabilities against $6.9 billion in assets. The company, that once employed nearly 100,000 people worldwide, was reduced to a skeleton crew of fewer than 2,000. The collapse devastated retirement savings. Over 60,000 employees and pensioners saw their promised benefits slashed or erased. Many received letters announcing pension cuts of up to 30%. Some were forced to sell their homes or postpone retirement. The average pension recovery after liquidation was just $4,500 per person, a fraction of what had been earned over decades. While workers faced ruin, Nortel's board approved $45 million in executive retention bonuses. These payouts, justified as necessary to keep key managers during the wind down, stood in stark contrast to the fate of the company's staff. The sense of injustice deepened as the company's most valuable asset, its patent portfolio, was auctioned off in 2011. Apple, Microsoft, BlackBerry, Sony, and Ericsson paid $4.5 billion for 7,500 patents. The proceeds went to creditors, offering little relief to former employees. The core of Nortel's innovation, built by generations of Canadian engineers, was scattered among rivals, while those who created it were left behind. In 2013, a Toronto court acquitted Frank Dunn, Douglas Beatty, and Michael Goligly of fraud, citing the complexity of the case and lack of clear criminal intent. For many, the verdict was the final insult, a system that punished workers and pensioners, but let those at the top walk away untouched. Nortel's collapse stands as a stark warning of what unchecked ambition and financial engineering can destroy. Today, Nortel's patents fuel global tech giants, while thousands of former employees still battle for lost pensions. Frank Dunn, Douglas Beatty, and Michael Goligly walked free, but trust in corporate leadership did not recover. As Canada courts new tech ambitions, the lesson remains. Unchecked greed can erase even the greatest empires, leaving innovation and lives broken in its wake. What price are we willing to pay for progress?